2025 taught us something critical. The old playbook is broken. You can't just buy QQQ and call it a day anymore. 2026 is going to reward selectivity, not blind optimism. Wall Street just dropped their 2026 forecasts. Deutsche Bank, 8,000 on the S&P 500. Goldman Sachs, bullish. Morgan Stanley, same story. But here's what they're not telling you. The market is more concentrated than it's been in 50 years. The top 10 stocks are driving half the returns. And if you're Canadian like me, blindly following American investment advice could actually destroy your wealth. I'm Alex. I hold 70% of my portfolio in US stocks. And today I'm walking you through exactly what I'm selling, what I'm buying, and the tax strategies that most Canadian investors completely miss. Look, I get the excitement. AI spending hit $200 billion this year. Tech companies are printing money, right? Wrong. Here's the uncomfortable truth. Microsoft, Google, Meta, they're all spending tens of billions on AI infrastructure, but their earnings per share barely moving. We're in this weird phase where the spending is real, but the profits are still theoretical. Meanwhile, interest rates didn't come down like everyone predicted. The US 10-year is still hovering around 4%. And for us Canadians, the weak loonie means every mistake costs us 35% more than it costs Americans. So let me show you exactly how I'm positioning my portfolio. First, let's talk about what I'm trimming. This isn't panic selling, this is portfolio hygiene. First up, the trade desk. I love Jeff Green and the whole programmatic ad story. That said, Amazon's ad business is really eating their lunch. They have the data, the scale, and the ecosystem. Trade Desk trades at 80 times earnings while facing its toughest competition ever. So I'm taking my loss here, harvesting it for tax purposes and moving on. Next, there's Advanced Auto Parts. This one ran up nicely, but the upside is mostly gone. It's a retail turnaround story in a market that doesn't reward turnarounds anymore. The risk reward just isn't there, so it's another position I'm trimming. And then, United Health and Humana. Medicare Advantage is under political scrutiny. I don't care if you're Republican or Democrat. When both parties are upset with your business model, that's a clear red flag. These stocks might recover, but I'm not willing to hold through that uncertainty. Here's my philosophy. In a concentrated market, every position needs to earn its place. If I'm not confident a stock will outperform, it's gone. Now let's move on to the good stuff, the positions I'm adding for 2026. First, Toast. This is my highest conviction ad. Toast dominates restaurant payments and management software. They're not just processing transactions, they're running entire restaurants, inventory, payroll, delivery, everything. Revenue is growing 20% year over year, and they're generating real free cash flow now. Even though the stock got hammered in the recent sell-off, the fundamentals are screaming. This is rare, a growth stock that's actually profitable. Next up is Meta. Everyone's worried about AI spending, but Meta is actually turning that spending into real profit. Their AI ad platform is almost fully automated, and advertisers don't even need to create ads. The system does it for them. And those Ray-Ban smart glasses, they're selling like crazy globally. Meta is winning the AI race where it really matters, revenue. Finally, I'm adding Amplify blockchain ETF. Now I know crypto is controversial, but hear me out. This isn't Bitcoin or some meme coin. It's an ETF that gives you exposure to tokenization, blockchain infrastructure, and companies building the financial rails of the future. It's diversified, safer than individual crypto stocks, and captures long-term US growth in digital assets. All three of these have one thing in common: strong free cash flow and real competitive moats. That's what will win in 2026. Now, here's where being Canadian actually gives us an edge, if you know how to use it. Most Canadians just throw their US stocks into a TFSA and call it a day. Big mistake. Dividend-paying US stocks should go in your RRSP because of the US tax treaty. You recapture that 15% withholding tax the IRS would otherwise take. Growth stocks with no dividends, like Toast, go in your TFSA, so all your capital gains are completely tax-free. And if you're converting CAD to USD at your bank, you're probably paying 1.5 to 2% in FX fees. That's $1,500 to $2,000 on every 100,000. Using Norbert's Gambit cuts that down to almost nothing. It takes 15 extra minutes, but it saves you thousands. Here's my controversial take. I treat USD as a long-term asset, not a short-term risk. The Canadian dollar has been weak for years, and I don't see that changing. Holding USD is a hedge in itself. So here's how I'm approaching 2026. Remove what no longer works. Concentrated winners, political risks, stretch valuations. They're out. Add strong free cash flow companies that generate real cash, not just revenue growth. And optimize for Canadian tax law. This is non-negotiable. Copying American YouTubers is a recipe for disaster. CRA rules, mortgage rates, TFSA, RRSP, they all work differently. My portfolio is built for solid compounding growth. No moonshots, no memes, just high quality businesses at reasonable prices. 2026 is not a year to guess. It's a year to execute with precision. Hit that subscribe button. Your financial future depends on the decisions you make today. And remember, this is not financial advice. Always do your own research before investing.